What if I told you you could own a piece of commercial real estate for just 500 rupees? I'm Neha and welcome to PropSutra with Balaji Rao. Today we're decoding REITs, or real estate investment trusts. What are they? They're pooled investment vehicles that collect money from multiple investors and invest into largely income-generating real estate assets, such as offices, malls, retail shops, and hotels. Today, we're understanding what REITs are, how they operate, and how they compare to other financial instruments. If you're wondering whether REITs fits into your financial portfolio, this episode is for you. Welcome to the show, sir.
Thank you.
So today, I'd like to talk to you about REITs. In our first segment, I want to break down the acronym, understand the concept, and help people understand its structure.
Sure.
I'll start with something very simple. What are real estate investment trusts?
Okay, it's not that simple as you're making it out to be. REIT stands for a real estate investment trust. It's a financial instrument. It's a pooled investment instrument.
Okay.
Where you get lots of people to put in their money into a particular vehicle, which is the trust. And that trust goes and buys property that is mostly income generating.
Okay.
That means it buys commercial properties or retail properties or even warehousing. It can buy any asset class as long as there's a regular income flowing from these properties back to the trust.
Okay.
So the trust is actually a landlord of those properties.
Okay.
And what it gets back is rental predominantly.
All right.
Now, for structuring purposes, maybe we can go on later as to whether the net operating income will be of rent or interest or dividends. That's all separate. But basically, the main source of income for a REIT is rent.
Okay.
So the concept of REIT is a pretty recent concept because it started somewhere in the 60s in the US and it has come to India basically over the last 10 years. Today, people hold properties in different types of structures. You can still hold property in your individual name.
Right.
You can hold property in a partnership with a few people.
Okay.
You can hold property in a company if you want. A company can buy it. But the best way to hold property is an investment trust because it's most tax efficient and it is regulated by SEBI, the Securities Exchange Board of India. And in US, it is regulated by the Securities Exchange Commission, SEC. So it is a well-regulated entity and it allows participation of a large number of retail investors.
Okay.
That means it democratizes the holding of commercial property, which otherwise was in the hands of the rich and the wealthy.
Okay.
Correct? So to simply put, people get confused as to whether is it a property investment or is it a financial instrument? It is a financial instrument that does property investment.
Okay.
And it gets rental as its income and it divides the same amongst its owners.
Okay.
That is the most simplest way one can explain what a REIT is.
All right. Are there different types of REITs? Are they classified differently? On what basis are they classified?
First, the easiest basis of classifying REITs is what we call the asset class classification.
Okay.
So an asset classification is if I make a commercial office REIT,
yes,
then that REIT will go and buy commercial office properties.
Okay.
Whether it's in Connaught Place or BKC or anywhere.
Right.
If I call it a retail REIT, then that will go and buy shopping malls, high street, strip malls. So you have what is the asset that the REIT is holding.
Yes.
Giving its moniker.
Okay.
Suppose I call it a hospital REIT. Then naturally, it's going to hold hospitals.
Okay.
If I call it a hospitality REIT, it's going to hold hotels.
Okay.
So the easiest way to classify REITs is as per the assets it is intending to buy, purchase, and hold as a landlord.
Okay. Is there a minimum number of properties or units that a particular REIT needs to have to be considered a REIT?
So it has classification. That's why it is regulated by SEBI.
All right.
Okay. So it requires you to have that minimum sort of requirement of investors, AUM, the pedigree of the sponsor, because any REIT generally will have, because it's a trust, it has a trustee that's overseeing the operations. It has a manager that actually runs the operations.
Okay.
The trustee is only as a check and balance. Okay. And it has a sponsor. The sponsor is the one who actually promotes the REIT, but maybe initially bringing in his commercial real estate or retail real estate.
Okay.
So there's a sponsor, there's a property manager, and there's a trustee. So you have to have a pedigree to all of them to qualify to be these. You understand? So anybody and everybody will not be able to make a REIT. And that's why when it's a regulated entity, it becomes much safer to invest in a regulated entity as compared to invest in an unregulated entity.
What do you mean? Can you elaborate on
because
that?
Before the REITs came, you had these, even today you have fractional ownership. You have loosely an association of people or a LLP being formed, or even a private limited company that can be formed and own a property and enjoy the rental as income.
Okay.
It can be done. But these are not regulated directly by SEBI as a REIT.
Okay.
So naturally, whether they hold income earning property, whether they distribute everything as dividend, all that becomes questionable.
Okay.
So when it is regulated, REIT will have, as you will go on in our podcast, maybe you will be asking me those questions as to how much of its operational income does it have to distribute.
Right.
You understand?
Yes.
How much of it does it have to hold as ready assets and not under construction? So all these are regulated.
Okay. Can you elaborate on what you mean when you say income generating assets?
Well, an income generating asset is basically a property which you're holding and you're putting it out for rent.
Okay.
Okay, you're not using it for sale and you're not using it as your own operational thing. It's not your own office or your own factory or your own warehouse. It's income generating. That means you put it to a third party and you generate rent out of it.
Okay.
Okay. So any REIT, prima facie, because it's a property investment, and a property investment can make its money only through two ways.
Yes.
Either it has to rent it out and make money, or it has to keep buying and selling properties.
Right.
Okay. A REIT can do both, but buying and selling is not ideal because that's like shuffling your stock portfolio all the time.
Right.
Okay. So just like in a stock market, when you invest in a stock, you're waiting for dividends to come.
Yes.
And as and when you sell, you'll get the capital back.
Right.
With appreciation or without appreciation.
Understood.
Similarly, here, instead of stocks or shares, you are buying what we call properties that are rented out.
Okay.
And so you are enjoying the rental as income and you're distributing it to your owners.
All right.
The owners being the REIT unit holders, because the REIT is held as ownership by the units, just like a company is held in an ownership by the shares.
Okay.
Correct? So it is distributed as dividend. So whatever income comes.
All right. So does that mean a REIT does not invest in under construction properties?
See, the regulation as of now, for the larger REITs, at least 80% of its portfolio has to be ready properties or income yielding properties.
Okay.
And only 20% can be under construction.
All right.
Okay. In the smaller ones, I think is 90-10 in SM REITs. It's even more stringent.
All right.
So the bulk of it, the majority of the investment assets has to be income generating.
Okay. Is there a specific reason for this? Is it to protect investors? Is it just the nature of how this investment has been designed?
No, you have to look at the intention. See, if you want to participate in the real estate development profits, then you will go and buy the stocks of a listed company.
Right.
Correct? You have a lot of around 40 listed companies.
Yes.
So you can go and buy the stock of any one of those companies because then you will be partaking in development profits.
Okay.
What happens when you buy land, you construct a building, you sell the building and all that. Correct?
Right.
But suppose you say, no, that's too risky because it is high risk and higher reward.
Yes.
Correct? And you say, look, I always wanted to buy property and rent it out.
Correct.
And that's a very steady income. It's a medium risk, maybe a medium return, but I'm more happy with that. Then you're only wanting to buy properties that will earn income. that will earn a rent. No? So
Yes.
why will you again go back into development?
Correct.
Then you're making a khichdi, what we call.
So you've walked us through how REITs are structured. My next question is there any minimum investment amount required? Can I just, do I need to have a certain amount of money before I can purchase a unit of a REIT?
See, in the IPO stage,
Yes.
most of the REITs will have a minimum of 10 to 15,000,
Right.
which is not really much for
Yes.
somebody wanting to participate in it. But once it is listed, you can buy even one unit if it is available as an odd lot, what we call.
Right.
Or you usually buy it in market lots.
Right.
So it can be as low as 1,000 or 5,000 or 10,000 rupees, and you're there. You're also an owner of a prestigious building in BKC.
Right. Who can invest in REITs? Can an individual invest?
See, because it's listed on the bourses or the stock markets, anybody who can invest in the stock market can invest in a REIT.
All right.
So whether they're non-resident Indians, whether they're foreign portfolio investors, whether they're resident Indians, whether it's a trust, whether it's a company, partnerships, anybody who can invest in a stock market can invest in the REIT because it's listed like any other company.
Are the tax implications with REITs different from what it would be if I were to purchase a property physically?
See, the tax is only one aspect of it. So REIT is actually a more tax efficient vehicle.
Okay.
There's no doubt about it.
All right.
Why is it tax efficient? Because it's what we call a pass-through vehicle. A pass-through vehicle it is not double taxed. One of the people will be taxed. Either the REIT will pay the full tax and it will be exempt in your hands, or the REIT will not pay the tax and you will be paying it.
Okay.
You understand?
Yes.
So to that extent, it is a tax efficient vehicle. That is one of the aspects. Okay.
All right.
So if you own a property, you will also be paying tax once only.
Absolutely.
So to that extent, it will be equivalent to a REIT in a way.
Okay.
But can you own a property, say, which is worth 50 crores?
No.
You might not have the balance sheet to be able to do it.
Right.
You might want to diversify the risk. Even if you want to put 50 crores into commercial property, you might not want to just buy one property. No?
Yes.
So in a REIT, when they have collected 5,000 crores, they have put it across the board over 30, 40 million square feet. So they are diversifying your risk, whether it is a sort of a risk of location. Because some of them might be Mumbai centric, some of them might be Bangalore centric. They might diversify across tenants.
Yes.
Some of them might be loaded in favor of technology companies.
Right.
Okay. Some of them might be loaded in favor of BFSI.
Right.
Banking and financial services. So it depends on if you want to diversify your risk, which is what is the hallmark of a prudent investor.
Yes.
Then naturally, you will be having to go via a more widely diversified portfolio when you put your 50 crores. You understand?
Yes.
So it's a question of concentration versus diversification.
Okay. That's well put.
So that is the way, and it also raises money. No?
Yes.
Sometimes 50 crores might not be sufficient. Suppose you need 500 crores to buy a building.
Right.
Then anyway, you'll have to participate in a sort of a pooled vehicle in order to buy that building.
Right. What happens if a major tenant vacates or defaults? Does that affect distribution or unit price?
Yes, of course it will affect. You understand?
Okay.
Because it is dependent on rental income. So suppose if you don't pay me rent, I can't distribute dividends, right?
Yes.
But I will take action to recover my rent.
Okay.
But still, if you're bankrupt and they don't get the full dollar, then naturally it will take. So REITs do have market risk, what we call.
Right.
There is market risk, there is a regulatory risk, there will be risk.
Right.
You understand? Because suppose the vacancy is higher. Generally, if you see the REITs in India, they have an occupancy of around 90 to 95%.
Okay.
You will find that if that vacancy becomes 15%, and your occupancy drops to 85, for example, then naturally your income is lesser.
Correct.
Isn't it?
Yes.
Or if somebody defaults, like during COVID, we had problems.
Right.
Okay, to recover money, or the vacancies were higher.
Yes.
So you have to come out of it. So it has a general risk, market risk. It has a liquidity risk. It has risk like any other instrument.
Okay.
But where is the risk in the spectrum? Is it really low risk or is it high risk? Right. In my opinion, a risk of a REIT is somewhere in the medium range.
Why is the REIT structure designed to distribute most of its earnings?
Because the whole thing is it's a pass-through.
Okay.
It is not supposed to trap earnings and diversify.
Okay.
A pass-through structure is we are coming together to make some money and we are distributing the money immediately.
Okay.
So it's not some sort of a normal corporation doing development.
Okay.
And because it is passed through, the tax authorities will allow the tax efficiency. Otherwise, you can't actually tax something that is not being passed through.
Right.
Isn't it?
Yes.
So naturally, you have to have a high pass-through ratio, which in the REITs case, it is 90%. Otherwise, if suppose you say that it will be taxed in the hands of the unit holder of the REIT.
Right.
Then if he does only 50%, then 50% is not being taxed. No? So the tax authorities then lose that amount, isn't it?
So it's more liquid, it's more tax efficient.
It is. It is simply a pooled investment vehicle to distribute the income.
Okay.
And you're pooling it together so that you have a better diversified portfolio. You can get better assets.
You can participate in much larger investments.
Absolutely.
I'd like to talk to you. In India, we had our first the REIT that was introduced in 2019, which was the Embassy Office REITs. We have 5 REITs now. Over the last 6 years, it's grown. We also have the introduction of SM REITs. Would you like to tell us a little bit about how the last 6 years have been?
Well, the REIT regulations came into effect in 2014.
Right.
But there have been a lot of discussions and deliberations going back and forth between SEBI and the industry to figure out how best it can be actually taken to the market.
Yes.
So somewhere in 2019, as you rightly said, Embassy Blackstone brought out their first REIT.
Yes.
Which was quite a landmark, very successfully received. And then after that, we had 4 other REITs, one of which is also a retail REIT.
Yes.
And is doing very well again.
Yes.
One of the main things behind all these REITs has been a large sponsor like Blackstone, who had been holding these assets along with promoters and who would naturally enable and catalyze to bring them into the REIT thing so that you can democratize and create more of a wider participation in the ownership of that property.
Right.
So the growth and evolution of the REITs has to come via these large sponsors and promoters who can slowly bring it. And now more and more Indian developers are open to that. We have a couple of REITs also in Singapore, which are being based. But there the problem comes in if the assets are Indian and the rental is in Indian rupees, you're also taking what we call a forex risk. Because you are invested in Singapore dollars, you're getting money in Indian rupees. You're converting Indian rupees into Singapore dollars every time a dividend is declared. Okay. And that can naturally be going against you. Because as of now, because of this crisis, geopolitical crisis, say the Indian rupee has slid.
Right.
So if it is sliding, then naturally it is eating away into your income. No?
Yes.
The same number of dollars you won't get.
Yeah.
Correct? But they have been to Singapore-based trusts also, which have been created.
We have Capital Land. We have Capital Land India Trust and we have Maple Tree.
Very good. Yes. So these two are there.
Yeah.
So you have them also. And then what SEBI saw is that there's this growth of fractional ownership SPVs.
Right.
Like LLPs and all of them, which have been created to buy properties. And they are smaller properties and they might not be grade A properties sometimes, or they might be in tier 2 cities. Whichever way, they said that let's create something which is useful when somebody wants to have a corpus of say 500 crores instead of 5,000 crores.
Correct.
So they created the SM REIT regulations.
Okay.
And that is now being studied. And we have 2 or 3 that have got registered and done it. I think just a recent one has happened, which has been well received by the markets. So from PropShare, I think it is listed.
PropShare.
So these are coming of age.
Yes.
If you ask me, REIT is a perfect financial instrument for any sort of wealth creator, wealth manager, financial advisor.
Okay.
Because you have the equities, no doubt, which should be a portion of your portfolio, which is more of a higher risk and higher return, depending upon naturally the type of shares you're buying. And you have the low risk, low return, which might be just the term deposits or government bonds or AAA bonds. Correct? So you need something which is hybrid in the middle.
Okay.
And REITs fits that.
Okay.
Because it is not as risky as an equity share because we don't go into development,
Correct.
maybe only up to 20%.
Yes.
It's a steady income
Yes.
and it gives you better returns generally than a term
Debt.
deposit or a fixed deposit.
Okay. You can hope to earn more than a debt instrument and it's less riskier than an equity instrument.
Yes, more
Just
than
broadly.
a typical AAA debt instrument.
Right.
If you buy a junk bond, it might earn more than a REIT.
Of course. So recently, SEBI had changed some regulations which allowed for the reclassification of REITs as equity instruments.
Correct.
They did this with the purpose of allowing more mutual fund participation.
Yes, because mutual funds were confused as to which fund should be used to buy the REITs.
Right.
Should it be an equity fund? Should it be a debt fund?
Right.
So they have finally classified it as equity because it is typically equity. It is an equity ownership.
Okay.
Typically, when you own a unit of a REIT, you do not become what we would call a creditor.
Creditor. Understood.
You understand?
You're the owner.
You're the owner. So it is an equity ownership.
Right.
Though it is of a medium risk equity ownership because it is governed by a lot of property and there is a concept of loan to value, which is the leveraging a REIT can do against its properties. There it is capped to 49%. It has to be below 50%. Okay. So you know that you have substantial assets as a buffer. And these are commercially viable and marketable assets.
Right.
That is why the risk is lower.
Is it also because real estate is the underlying asset and real estate is very stable?
Not only stable, real estate is an appreciating asset.
Okay.
You understand? If you buy any technology or factory machinery, that's a depreciating asset. But real estate is the only thing that's an appreciating asset. Like sometimes we have gold as a depreciating asset.
Right.
So land, property, gold, all these are appreciating assets, we call it. Real assets.
So by that understanding, REITs, can they beat inflation? Do they beat inflation?
Yes, of course, because property in general always beats inflation.
Okay.
Now, the appreciation in property is only one aspect.
Okay.
The other is the rental. Whether you're saving rental or you're actually getting rental from a third party. Put together, the total return on an investment, as we call it, will always beat inflation. But you cannot take a capsule of 2 to 3 years or something and say in this period it didn't beat. You have to take a mid to long term, which in my opinion for real estate at least should be 10 to 15 years.
Okay.
When you take that sort of a period or a time gap, then you will see that it has beaten inflation, hands down.
So the registered REITs in India have largely beat the index. I would like you to comment on their performance in general.
See, if you look at the overall industry and how they have performed, I think it has been an excellent performance so far.
Right.
They have really gone through all the crises and you have seen them come out of it and they have performed well. The returns have been excellent. And overall, I think they are like a beacon. They are acting in the right way, which didn't happen during 2007 when we did the IPOs of the first few real estate companies.
Okay.
There, I think it was overvalued and immediately upon listing, most of them tanked, what we would call literally.
Okay.
Whereas out here, I think they have performed much better and they are really becoming what I would call the sort of go-to product for somebody with a balanced approach.
Right.
Who says, look, I want something more than just a term deposit, but I want it to be safe.
Yes.
I don't want to take the risk of an equity share. So I think it's a perfect go-to product. And there has been a good retail participation. So in most of the REITs, though, you still see promoters holding quite a bit. I'm sure over time it will get diluted.
Yes.
And there will be wider retail participation in the REITs, indicating its acceptance as a good market participant.
As per our research, broadly speaking, retail participation hovers around 15 to 20%. Do you see that growing or doubling over the next decade?
Yes, it will. Okay. Because as they expand more, promoters might slowly start diluting.
Okay.
Initially, promoters will be more hesitant to dilute as they don't want to lose control.
Right.
But they'll slowly dilute over time, which has been the same thing abroad also quite often.
Okay. The Indian REITs today have invested largely in grade A commercial spaces. Apart from Nexus Select Trust, which invests solely in retail, the rest of the REITs are all commercial REITs. Whereas if I compare it to Singapore, for example, which is one of the most mature markets, that's largely warehousing and logistics. Why are we concentrated on commercial real estate in India?
Well, it's quite simple. Let's say India has roughly today a grade A or whatever you can call it, about 700 million square feet of office space.
Yes.
Okay. Our REITed asset, that means those which have come under REIT, is about 140 million square feet.
Okay.
So there's a lot of potential for REITs to grow. One.
Yes.
Two, our REITs market cap is about 20 billion.
Okay.
Okay. When you compare it to an overall global market cap of 2 trillion or even our own stock markets, it's a very small percentage.
Okay.
So there's a huge upside because REITs can even go up to 10% of GDP.
Okay.
You understand?
Yes.
And we have the stock also for it.
Right.
Also saying, so both on the quantum, the supply side, as well as the depth of the market, there's still a long way to go.
Okay.
So Singapore is also great, but it's a sort of what we call a city state. Okay. It's a smaller economy because it's a much smaller place doing very well, one of the wealthiest countries. So, and it is also one of the major logistics distribution points, so shipping ports.
Yes.
So it will have a focus on logistics and shipping and warehousing as well as commercial.
Right.
But the same thing, if you go to US, it will be more focused towards maybe commercial again.
Right.
Okay. Or you go to Japan, J-REITs, it will also be similar. So it depends upon what the country has to offer as supply.
Okay.
You understand?
Yes.
So that's what you're seeing. So we have a long way to go. I think we're just scratching the surface as of now.
So if we compare the Indian REIT market on a global scale, we are very slow.
Because the global REIT market would be about 2 trillion, out of which dominated by US by 1.2, 1.3 trillion.
Yes.
And we are 20 billion.
We've got a long way to go.
Like I often give a nice statistic. I think mid-Manhattan would have about 450 to 500 million. At one time, it was equivalent to the entire commercial office stock of India. And that's just what we are talking about, Manhattan office space.
Right. But do you think with more institutional investors coming into India, the landscape will change? We'll have more REITable stock even in residential or
absolutely. Because in commercial, the concept of buying and holding your own office is a little bit archaic. You can have maybe a corporate office just as a trophy asset. Right. But generally, all your commercial needs to staff your people can be rented out, and it should be.
Right.
So naturally, it needs to have a landlord.
Yes.
You understand? That is why the growth of REITs. Previously, we all used to have strata title, what we call.
Yes.
You see a building in Nariman Point, it will be owned by 32 offices, just like 32 residents in a regular residential building. Correct? Yes. But that doesn't work because they cannot maintain it. They cannot really refurbish it in any way, nothing. The same Express Towers, which was owned as strata, when it came into the REITs, has completely changed and out that.
Okay.
It looks like a very posh grade A building today.
Okay.
So it does make a difference if you're institutional owned.
What are your thoughts on the residential sector perhaps becoming REIT ready?
See, the residential sector will become REIT ready because as of now, our rental yields hover around 3%.
Yes.
To get REIT ready, they have to move up, almost double. Can they double? Yes, they can. But it'll come up with bells and whistles. That means you'll have more what we call furnished apartments, serviced apartments, apartments with a lot more sort of concierge-like services given.
Yes.
So people will pay quite a lot more than just what they pay generally for a base shell.
Right.
So if I'm willing to pay for a base shell at 2 BHK 50,000 rupees per month, and if somebody says it'll come fully furnished, just come with your suitcases, their white goods, their brown goods, and it'll come with a concierge and everything, I might be willing to double it to 1 lakh.
Right.
Because it gives me less of a headache. And I think I need to be here for 2 years. Why do I need to invest in all this? So that's because with mobility and the way the Gen Z, the Gen Alpha people think, they want to experience. They want to experience good stuff. They don't want to slum it out because that's over. That's what the earlier generation did. So why wouldn't they want to spend 1 lakh and enjoy a good, well-furnished, well-appointed 2 BHK than to go to a base shell and try to buy a cheap mattress. It doesn't work.
So you're saying somewhere we're also witnessing a change in consumer behavior, where people are shifting towards rental or seeing more value in rentals.
Yes, completely. If you see the new consumer, they look for experience. You understand? You go to a concert for experience, not just for the song.
Yes.
You understand? You can hear the song. You can hear John Mayer's song anyway. But you want the experience. That's
Right.
why you're going for it.
Yes.
You understand? So a Coldplay concert gets sold out because of the whole experience. Correct?
Yes.
So everybody wants an experience.
Right.
So if I tell you that if you can afford 1 lakh to pay for your 2 BHK, why aren't you in this condominium which gives you these services, these amenities? You can go to the spa, you can play squash, you can take your dog for a walk, and it's a well-appointed one. Whereas the neighboring building, he can get a bare shell for 50,000. He might say, I want that experience if I can afford it, of course.
In our last segment, I'd like to summarize everything we've been discussing. So once again, how do REITs compare to other financial instruments?
Well, as I said, most financial instruments are put in a sort of a spectrum from low risk to high risk.
Yes.
Okay? Because there's a risk-reward parity that cannot be really refuted.
Yes.
Okay? So, REIT is a financial instrument that basically has an underlying property investment in its own way. So if you want to say where does it lie in the risk reward sort of a spectrum, I believe it lies in the middle. It's a medium risk, it's a medium reward sort of an instrument.
Okay.
So when somebody decides that he wants to do something more than a low risk,
yes,
low reward because of whatever reason,
yes,
you need to have more income, then it gives you the perfect sort of a opportunity to participate in a REIT. Because the risk is lower, the return is slightly higher than what you would get from a term deposit or a low risk product. At the same time, you're not exposed, as I said, like an equity, to very high risk. It's more suitable, in my opinion, if you want me to elaborate further, because we have a sort of the rule of the thumb.
Yes.
That your age, 100 minus your age, should it be what your percentage of equity should be.
Okay.
You understand? That means we sometimes believe if you're 30 years, you can invest 70% of your money in equity.
Okay.
100 minus 30.
Right.
Whereas if you're 50 years, you should have 50% in equity and 50% in
debt.
Non-equity.
Yeah.
Debt or this. So when you go as per that, it's naturally more suiting middle-aged and seniors. It might not suit a young person because a young person feels like you that if I invest lots more in equities, even if there's a higher risk and I take a loss, I can recoup that because you have a working life of maybe another 30, 35 years.
Correct.
Okay. Whereas an old person who has a lifespan of only 10 years left for working, he will not want to take that risk. He can't recoup back if he's had a setback.
Right.
You understand? So that is why it is more suited towards the more mature investor, in my opinion.
And to cover this again, how does a REIT compare to buying a flat or a commercial property directly for income?
See, the comparison is that maybe the underlying asset might be the same, but we believe that if the underlying asset is more diversified, you're safer.
Yes.
Your risk profile becomes lower.
Right.
So when you buy one particular flat or a commercial property, you're concentrating that investment into one.
Yes.
It's like buying a equity index fund as compared to buying one share in a company or putting all your investments in one share. Let's assume. You understand? One's company. So you're concentrating it. Two, it is also going to be a problem from liquid. When something is listed on stock markets, it's easier to liquidate that investment.
Right.
In 24 hours, you can literally liquidate and get your money. Okay.
Yes.
Whereas when you are in a property, it'll take you at least 3 months to liquidate and get money.
Yes.
So there is a difference. So unless that property has some significance to you, either because you live in it and you don't want to live in a rented property, or it has some historical significance. I don't think you should buy property in a concentrated manner.
Okay.
I would always tend to encourage people to go via a fund or a REIT.
Understood. How do interest rate changes, repo rate changes impact REIT valuation and yields?
You see, the benchmark everybody thinks of a rental is it should be compared to the interest rates and the inflation rate.
Yes.
Okay. So typically a rental will be in some way there, covering interest as well as inflation.
Yes.
It should always try to clear these two hurdles.
Understood.
Okay. Not together, but even if individually, like say your repo rate today is 5.25, if I'm not mistaken, your inflation might be maybe it's lower, 3-4%. As long as your yield is coming more than that, you have an actual accretion. Otherwise, it's all being swept away, as
Correct.
to the minimum low risk thing. Why would somebody put at something at 6% if at 5% I'm absolutely no risk sort of thing? Correct? So it should clear those hurdles. So that is the way it can benchmark to a certain extent. And that's the way rentals also operate. You'll see.
Understood.
Slowly they'll get adjusted over time.
Does the rental rate readjustment lead to capital appreciation?
Exactly, precisely. Because if you see, suppose at a particular time, you have taken an office property and the rate today is 80 rupees a square foot.
Correct.
We usually would take 5 to 9 year leases.
Yes.
With some sort of a 5% depreciation.
Yes.
So with that 5% depreciation after 5 years, okay, it might have come to a particular level. Say it was 110 at that time level.
Correct.
But the market has moved up.
Okay.
But you have tied up, so you have got it till at 110 for your last year maybe. Okay.
Correct.
But the market has moved up, and after 5 years, the market rate is now 125. So when you come to me for a renewal after the contracted period, I will now take the base as 125. No?
Yeah.
You will not get it at 110.
Correct.
So this is what we call the readjustment of rentals. Because why it has become 125 is because that 125 rental rate is what is suiting that interest rate, cap rates, repo rates, inflation rates of that time.
Okay.
Whereas because I've been contracted and locked in, I had to maybe in a way suffer getting 110 from you, though the market was 125. I had already contracted with you for 5 years.
Right.
But after 5 years or 6 years or 9 years, it has to change. That's called re-rating. It'll adjust itself to the market rate immediately.
Understood.
So when it comes up, that means there's a capital appreciation you immediately get. Because the capital appreciation is based on the cap rate.
Understood.
That means based on how much rental I get, I put a cap rate to it.
Right.
Okay.
What kind of developers or asset owners typically go down the REIT route?
See, most developers, when they are developing all sorts of asset classes, they'll also be developing office properties, and all of them don't sell it off as strata ownership anymore.
Okay.
Some of them hold it.
Right.
Under their own name so that they can earn a rental income and
Yes.
also use that property as a collateral for certain loans.
Understood.
Okay. Now, when you have a significant portfolio of such,
Yes.
you develop over 10 million, 15 million, then is it REITable? Yes, it is eminently REITable.
Okay.
You don't lose control and it becomes a total separate business unit by itself.
Okay.
So you can keep developing and then selling it to the REIT, whatever you're doing, and still control the REIT because you have a significant promoter stake in it.
To conclude this episode, I would like to ask you, what is your take on the future outlook for REITs in India?
Well, I truly believe that REITs are here to stay and they will grow. There's a huge sort of a growth and expansion of REITs which can happen. Because as long as you have office property and other assets that are rentable, including, as you said earlier, residential can come under this thing, hospitals can come, even school buildings and college buildings can come under REITs. I think it is the most logical, tax-efficient solution.
Yes.
Where you have a separate sort of an ownership of those properties.
Yes.
And you have a separate user who is paying rent
Right.
for what he actually uses. And it is a very viable alternative. It's extremely well regulated.
Okay.
So as long as it's well regulated and well received by the market, I think the growth is going to be extremely strong.
So we're just getting started.
We are just getting started, exactly.
Thank you so much, sir.
You're welcome.